In a world flooded with complex portfolios and flashy stock picks, sometimes the smartest move is going back to the basics, but with a modern twist. Vanguard founder John Bogle gave us the original three-fund portfolio. But what if I told you there's a modern version, leaner, higher yielding, and built for today's economy, that could leave the old model in the dust? Here's a modern three-fund portfolio that is leaner, high-yielding, and it's built for today's modern economy. Before we start, remember this video is for educational purposes only and does not constitute financial advice. Always do your own research or consult a financial advisor before making investment decisions. In this modern three-fund portfolio, we're replacing bonds and international funds with smarter, more relevant assets. So, here's the breakdown of our foundational ETF for our core U.S. market exposure. Let's start by choosing between SPLG, which tracks the S&P 500 and has the lowest expense ratio of just 0.02%. VTI encompasses the total U.S. stock market with over 3,700 companies. Or you may want one of the most popular ETFs, which is VOO, which also tracks the S&P 500, which holds 500 of the largest companies in the U.S. Any one of these ETFs gives you a broad, diversified exposure to the U.S. economy. It's the foundation of your portfolio. Next, we add dividend income to our portfolio, creating a cash flow engine. Dividend ETFs are exchange-traded funds that invest in companies known for paying regular dividends, providing investors with consistent income and potential long-term growth. This is popular among retirees and income-focused investors because they combine stock market exposure with cash flow. SCHD, VYM, or FDVV are quarterly payers with strong dividend histories. If you're nearing retirement or already retired, you may want to exchange a quarterly paying ETF for a monthly payer like SPYI with a 12% yield, or QQQI with a monthly payout of around 14%. If you had $25,000 in SPYI averaging a 12% yield, that could pay out around $3,000 a year. QQQI with its 14% yield would pay about $3,500 annually. Combine them and that's $6,500 annually, or $541 a month. Finally, we need a growth ETF for capital appreciation. You can't go wrong with any of these three. VUG is the Vanguard Growth Fund. It has delivered a total return of approximately 359.5% over the past 10 years, which translates to an average annual return of about 16.5%. QQQM launched in October 2020, so it doesn't have a 10-year track record. However, it closely tracks the NASDAQ 100 index, just like its older sibling QQQ, and its performance since inception has been strong with an annualized return of around 11% per year. SCHG is the Schwab U.S. Large Cap Growth ETF. It has returned approximately 16.87% annually over the past 10 years, with a total return of over 1,086%. That means a $10,000 investment in 2015 would be worth more than $118,000 today. It's also vitally important to build up your cash reserves. An emergency fund acts as your financial safety net, ready to catch you when life throws the unexpected, like medical bills, car repairs, or job loss. It helps you avoid debt, stay calm under pressure, and keep your long-term investments untouched. This allocation by retirement timeline shows how your investment mix could evolve as you approach retirement. It balances growth, income, and stability by adjusting the percentages in your foundational, dividend, and growth ETFs, plus a consistent 10% in cash. The further you are from retirement, the more emphasis is placed on growth. As retirement nears, the focus shifts toward income and foundational stability to protect your wealth and generate cash flow. This glide path helps simplify decision-making while aligning your portfolio with your changing financial needs. This modern three-fund portfolio outperforms the original Bogle model by replacing underperforming bonds with high-yield dividend ETFs, and by skipping international funds in favor of globally active U.S. companies. The truth is, bonds have been losing favor with investors. Bonds were traditionally seen as the safe part of a portfolio. But in today's environment, dividend ETFs like SCHD, VYM, and FDVV offer better yield, growth, and inflation protection. Many investors are now replacing bonds with these dividend-focused funds in their core allocations. And that's what we've done with this modern three-fund portfolio. While John Bogle's version relied on bonds for safety and international stocks for diversification, today's market favors income-generating assets and U.S. giants like Apple, Starbucks, McDonald's, and Amazon that already operate worldwide. This updated approach delivers better returns, simpler management, and more relevant exposure for today's investor. The beauty of this strategy lies in its simplicity. By using dollar-cost averaging, you remove emotion and guesswork from investing. By automating your contributions, you keep steady, consistent progress. Rebalancing once a year keeps your portfolio aligned with your goals, and from there, it's a true set-it-and-forget-it system. No chasing trends, no constant tinkering, just a boring, effective path to long-term wealth. This modern three-fund portfolio goes beyond being a simple investment strategy. It's a disciplined mindset built around clarity, steady contributions, and reliable income. Whether you're decades away from retirement or already enjoying it, this framework evolves with your financial journey. Please take a few seconds to like this video and be sure to subscribe so you'll never miss another one. Thank you for watching.